Yeah, hello. Hello, hello, hello. Hello. We can all start sitting down. Can you hear me? How's the sound in the back? Can everyone hear me? Is the sound good in the back? Okay, perfect. So yeah, I guess we can get started. Thank you all for coming. I know the competition is fierce tonight with Vitalik on stage at DAppCon. That's pretty tough. But yeah, thanks for coming. So we are here tonight to talk about decentralized finance and the future of finance, which hopefully will be a more open, inclusive, and transparent one. And so yeah, we've organized this evening centered around two panels. One which will be on DeFi composability, showing some of the cool projects in the space, and the challenges that we're faced with and how to overcome them, and how working together we could create something that is more sustainable and that works. And then the other panel, we're going to be talking about marginalized industries and countries, where we have a few super interesting people and projects presenting about how does crypto make sense in Somalia, and if so, why? And so I'm super excited. So I would just, without much further ado, like to introduce Max Mersch from Fabric VC, who's going to moderate the first panel.
Awesome, thank you very much. Hello. So if all the panelists could join us, Stani, Hugh, Leah, and Gustav, sorry. That'd be awesome. And so just to kick it off a bit on DeFi, why is it such an exciting sort of moment for DeFi right now? I guess we could argue that a large part of the end of winter in Web3 in general has been driven by DeFi, and we've got some of these really interesting core financial primitives which have been built, which have proven to be working, and now you've got developers who are actually building products by composing those different primitives. And from the investor side, that's really exciting. And couple that with the fact that we've actually got a good user experience. When you look at things like Argent, you can actually try to get your family and your friends to sign on to it and to use it without scaring them away too much. But so it's a topic that we're really excited about, and we got some great projects here. So if everybody could maybe just quickly introduce themselves, the project that they're working for, but also what probably the most exciting thing is that they're looking forward for in the next couple of months or years. But keeping it brief, a couple of minutes or less, 30 seconds per person.
Hi, Hugh Carp, I'm the founder of Nexus Mutual. So Hugh Carp, founder of Nexus Mutual. We're doing basically trying to be doing the insurance vertical of DeFi. That's our idea. I guess just what I'm kind of really excited about is, I get worried that with money Lego, we're creating massive systemic risk, and hopefully we're just one part of kind of subtracting from some of that risk. So that's what we're trying to do.
Okay, I'm going to try to keep it as short as you. I'm Leah. I work with Centrifuge. I do partnership management there. And at Centrifuge, what we do is we built an open protocol for the financial supply chain. So we started out with connecting supplier and customer, enabling them to exchange documents peer-to-peer in a secure, private, and verifiable way. We also allow these businesses to tokenize these documents, so mint an NFT, and in the past few months we have been realizing that to actually use these NFTs then, or these assets to borrow or access liquidity in DeFi, and we have been realizing over the past few months that DeFi doesn't necessarily speak NFT, or there's not so much happening with NFTs. So as a natural extension sort of Centrifuge, we have been building Tin Lake, which allows the bundling of these NFTs. Then based on that, ERC20 tokens are minted that then connect with the lending protocols that are out there, such as Compound or Maker. And starting with invoices, we have been expanding to other industries as well, such as real estate, royalties, etc. So that was really exciting for us in the past few months.
Hi, so I'm Gustav, and I'm responsible for the European business development at Maker. I also do a lot of our projects in both Asia and Africa. Maker, we are a decentralized stablecoin issued by a permissionless lending protocol. Right now, we only collateralize by Ethereum, but this fall, we will launch multi-collateral DAI, which will allow us to lock up other asset types, such as the NFTs we talked about here, and other crypto tokens. But specifically, I'm very, very interested and excited about the real-world assets that will be brought to the blockchain, and where we will allow liquidity and credit against them.
Cool. Hello. Yeah. So my name is Stani Kulachov. I'm the founder and CEO at Aave. So basically, Aave is a kind of project that started with small experiment on lending. Basically, we wanted to create a trustless lending protocol in Ethereum, and came up with the first kind of like lending protocol called ETHLend. And this small idea became actually a business model, and then eventually a startup. And now we're based in London and Switzerland as well. And basically, what we are currently doing is we are creating lending pools on Ethereum. So basically, I think now DeFi is about kind of like deposits and how much you earn interest on your holdings. And what we are trying to look with the lending pools is actually the borrower's perspective. Like basically, is this product the best product that you can have on DeFi on lending? So our pools are basically included with interest rate swaps, where you can swap between fixed and variable rates. And that is something that we're working like 24/7 now. And yeah, and the funny part is that actually what we are doing, we're basically supporting DAI. So the borrowings are usually in DAI, and basically collaterals can be any kind of ERC20. And with help of Centrifuge, for example, we are able to get real assets and large liquidity pools that you guys can actually enjoy.
Very cool. And that sort of starts next question.
And probably an insurance from Nexus as well.
So diving into that, so we were hinting at what's possible if you compose all of these different projects together, what sort of products can be built. If you sort of think forward 10 years, what can be built that just wasn't possible before? It's an open question to everybody, but what do you think, what's the most exciting thing you could possibly think of in the next 5 to 10 years?
Well, I can't break the ice. So I think it's very hard to say like 10 years because the next 12, 24 months will be crazy enough. I mean, there's going to be a lot of interesting projects. I think especially insurance field is something I'm looking very, very interested in, because now there's different kinds of projects going on there. And what I think is interesting also, kind of like the derivatives products that are coming in. But I think the very thing is what I see now is kind of like the DeFi foundations are starting to form. There's basically a decentralized stablecoin like DAI that you can use in different kind of projects. There's lending protocols like basically Compound and our lending pools. And basically what I think is now that there's kind of like a layer of DeFi, there's going to be a second layer of different kind of products that are connecting in this money legal style, that you can actually create different kinds of products. And of course you have the interaction level, so you don't need to interact with always the same UI that we provide you. So there might be builders here that are more kind of enthusiastic to create more easier user experience. And one example is basically InstaDApp that created just a simple way to make a CDP with one transaction, and that's a very interesting product as well. So I think for the 10 years, I'm not sure what's going to happen, but at least that's my prediction for at least the next couple of years.
I mean, I guess I could speak from our perspective. I think what we are really excited about DeFi is to actually bring, I mean, we have been talking about it, to bring real world assets, or the assets, the crypto native assets on-chain, and then actually allow smaller, medium-sized companies to actually borrow or lend on their terms. So I think it's always a little bit better to understand, given an example. So I mean, we are coming, or like our home turf is invoice financing. So what happens a lot, or what's in the traditional world, how it's handled right now is I, as a company, I deliver a product or a service, I invoice my customer, and then on average, I have to wait like 2 to 3 to 4 to 5 months to actually get paid. But in the meantime, I have material costs, for example, or I have to pay my staff, I have to pay the IRS, etc. And this then gets really expensive. And how I bridge that gap in the traditional world right now is I either go to a bank, but I can only do that if I have the right size and the right customers, so maybe they won't even take me. And I can do factoring, traditional factoring. There are already businesses out there that do that, but I often have to commit all my invoices for minimum a year or something. So this then in the end also gets quite expensive. And for example, what we've built with TinLake is you can actually decide which invoices you can finance. And you can also, it then becomes financially viable to also invoice or finance small amounts of invoices, for example. Or, I mean, we have been also looking at other assets. Sometimes an artist at Spotify has to wait 2 years to actually get paid. And I think there's a lot that can be improved upon on this, so I'm really excited to make that possible with DeFi.
Yeah, I think we're going to start with all of the replicating the regular world's financial products, because that's kind of what we know. But if you look back at other technologies, I don't know, you get video streaming, and who would have thought that people spend a lot of time just putting pictures of their cats up, or of taking photos of their food, or what, because we've got digital cameras, and we can just do a whole bunch more stuff now. And so I think we'll start doing the things we know about, but there's going to be a whole bunch of other stuff that we don't know about yet, and I think that's the potential of what we're doing. You know, you got the Lego set, and you can build whatever you want now, and I think that's what makes it really exciting.
Cool. Do you want to add anything, or
yeah? So I don't really have that much to add. I think you went through some of the good stuff, but at Maker we really just focused on getting the protocol out, and then I won't even begin to think about where we would be in 5 or 10 years. I believe in specifically with some of the partnerships, also with some of the projects here. There's so much potential in it, right? And we're entering a space where, because we have these permissionless protocols, we have a reach that's completely unparalleled. Currently, a lot of the traditional finance is very biased against things such as race, religion, origin, and current location, and we're really excited to take and then remove those parameters, to the extent that it's possible from it, right? So we see a lot of people also being underserved just because they don't have a bank that's nearby them, they simply don't have the access to actually go there. And as we see technology just being able to reach out with better data signal and internet for the entire globe, then all of a sudden these services that act as these permissionless protocols, they can actually reach people that before just wasn't possible to reach. We also, we kind of are set up in a way so we are a decentralized bank in a way. So we will also have a completely global network, and we completely live on the blockchain. So where banks today is often very tied to jurisdictions, so some of their core markets, we will also have completely unparalleled reach there, where we can just go out and do business wherever it makes sense for the people who would receive our service.
Yeah, that's awesome. And you both, Leah and Gustav, you seem to have touched on the idea of who the end customer is. And if we look right now at where or whom DeFi is touching, it seems to be largely driven by people who are looking to go leverage along on ETH at least, or at least over the past couple of months it has been. When do you think we start reaching the longer tail of customers or users who just previously didn't have access to some of these services? What's still required? Is it the onboarding that's still missing, or what do we still need?
Yeah, so I mean, right now, whoever interacts with a DeFi protocol, they're relatively tech savvy, and they interact through their own custody normally, and you need to be relatively tech savvy. Yeah. So we're working on a variety of solutions which will give people the benefit of the blockchain technology without them actually needing to be experts in setting it up. So one of the products, we're launching 2 different products in that field with 2 different partners. One of them is going live next week. They're called Outlet.finance. So basically they allow people to send dollars through a bank transfer in the US. They will then automatically on-ramp it into DAI and then put it in Compound. And then they can offer people, dollar savings account. So in the US, I think it's cool, but I'm really excited for the other project where we're doing a similar thing with a partner from South Africa. So that will basically allow people to send South African rand, and then the rand will get turned into DAI and Compound again, similar service. And later on when we will also launch our own interest rate product on DAI. So it could also be that one, for example. But there you don't need to have a wallet, or you don't need to have keys or anything, because it's basically just the protocol that you're using to receive the interest that takes custody of the assets. So you just need someone to facilitate the onboarding, like the on and off ramp from fiat to crypto, and then you can actually offer like a product that gives people the benefits without them having to have a MetaMask and set up everything and interact with it with their own funds, but they can just interact with it purely from like a fiat perspective. Then they would just have a very nice UI where they can view the balance, how much they've earned, and when they pay out, they just do an automatic off ramp into South African rand, and then people will have their cash back in their bank account. So I think like it's products like that we need to reach, like the more normal people, because currently right now, like people are not tech savvy enough, I guess, in general to actually, be part of this like Ethereum wave.
Got it. No, that makes a lot of sense. And I guess from your side, you're a bit more in the background. You're working more with developers who want to offer a product to actually ensure maybe a contract, or if you're building a product that depends on 3 or 4 different smart contracts.
Yeah, we essentially, like, insurance is always, we're not legally insurance, but insurance is always a secondary purchase off something else. And so basically if, for example, people want to put money in Compound, then we've discovered that more people want to put money in Compound if they can also have some cover as well. They get more comfortable. And so that's just one example. But if you want to interact with these platforms and you're worried about the technical risk of the smart contracts failing, then we can get some, give you some cover. And so that kind of, it helps, but the lead product and the lead kind of customer comes from somewhere else. It comes from a different reason. You want to do something, you want to earn interest, or you want to margin trade, or whatever you want to do.
Actually, I have a question for you. So like right now, like a lot of the funds are in relatively few contracts, and I've also like taken a look at your website, and I know some of people from Maker, they have taken like requests on like pricing. So I know that your prices are pretty low. If you become like overly exposed to, let's say, like Maker and Compound, because that would be probably the 2 biggest places where people would put insurance on it now. Like, what would you do if one of them actually failed? Like, would you be able to actually like cover the losses? Because that would be like an overexposure, right?
Well, yeah, we cap the exposure. So we limit the exposure based on the amount of funds that we have in the pool. So any particular contract, we'll only accept cover up to now 20% of the funds we have in the pool. So we're relatively small right now, and basically we're almost at capacity on things like Compound and Maker. But then we have to grow. We have to grow horizontally first. So we have to get diversification across the various smart contracts. And then once we do that, the pool starts growing, and we can cover, and that 20% becomes of a bigger number, and we can offer more capacity on everything. So yeah, it's absolutely pointless for us to just, as an example, the extreme example is we just cover Compound. But then we'd need 100 million because they've got 100 million in it. It doesn't make any sense, right?
No, but like, but is that a choice that, like, I know that you say that you cap it, but it's something that's like, it's difficult to make that choice not to do it, right? Because most people would have demand for the biggest protocols, and the biggest protocols have quite a big part of the market cap.
Yeah, well, we don't offer cover once we hit capacity. It's part of the rules. So, like, I mean, we could do it, but then we'd go bust. So it's kind of pointless.
I guess just like we often ask who watches the watchmen, in your case, who insures the insurer. Have you thought about what happens if your contract has an issue?
Yeah, exactly. I mean, yeah, of course. I think firstly, if you step back and say you want cover on Compound, if you buy cover with us, then if Compound goes down, then you get a claim. If we go down, then you lose your cover price, which is a relatively small amount. If they both go down at the same time, then that's the really bad scenario. And so, yeah, that is a risk. What we're thinking and how we're thinking about dealing with this in the future is our biggest problem is that the insurance industry is nowhere near offering cover for crypto native risks right now. They provide cold wallet cover in limited circumstances and 1 or 2 hot wallet covers for a few exchanges. Very limited. I know one of the biggest hot wallet covers, as an example, for one of the bigger exchanges was syndicated through Lloyd's, and it was syndicated with 10 different parties because no one wanted to take any massive exposure. So they're nowhere near doing this stuff right now. However, what we're hoping is that we actually have a DAO. It's linked to a legal entity, so we can actually buy a regular world insurance contract. And so in the future, maybe in a couple of years' time, we've got a bit bigger and we've got some claims experience. We can go to the insurance industry and they can offer capacity on top. And then essentially they're dipping their toe in the water into a new market. We're taking the first level of risk and they come in for the big catastrophe type stuff. So that's the plan, but it does require the regular industry to come to the party.
That sounds like you'll have some really fun conversations with
Yeah,
some insurers at
I've
some
already
point.
started them. Yeah.
What do you think about basically credit default swaps? So basically that to be counterparties that actually will take that kind of like substantial risk. For example, if there is like this big contracts, like for example, Compound or DCDPs, basically, is it kind of like different what you guys are doing?
So the main difference between like credit default swaps and I think prediction markets kind of fall into the same category is the fact that they're fully collateralized. So basically, if you want to cover say 10 million, you need 10 million somewhere. Insurance is all about under collateralization because that makes us more efficient. So that's the key benefit of what you do from an insurance point of view. There are obviously pros and cons, and if you can't get insurance, then a credit default swap may be worthwhile if someone's willing to take on the risk for a lower percentage return. But I think they're complementary.
Awesome. And so, Leah, last week, Tinlake announced $180,000 worth of Maker CDPs that were issued with a real-world asset, an off-chain asset, so 2 mortgages, which is a pretty exciting first step into the bridging between the on-chain and the off-chain world. Could you dive a bit into, first of all, what exactly that means in terms of that specific CDP, but also where does that stand in terms of regulatory aspects? Who enforces that?
Yeah, cool. So we have been working with Maker on, or actually we're still currently working on a number of pilots to build sort of the rails to get real-world assets into DeFi, multi-collateral DAI. And we have, last week actually, 3 pilots, so it was a really busy week before Berlin Blockchain Week. We tokenized several assets, so on one side invoices, so where we're coming from, but then also mortgage loans, so from the real estate industry. And so it basically within, I think for one loan, we actually needed I don't want to lie, but I think it actually only took 30 minutes to go through the entire process and issue a loan, so that was really cool. We've been working on the pilots. We have a few more coming up in the next few weeks with different asset types. So there's really showing the feasibility of the underlying technology and showing that DeFi can move a little bit beyond margin trading, and that companies actually can use the assets that they have and actually access liquidity for that. You've been mentioning the regulatory space. I mean, you've also touched upon it. We're not operating in a legal vacuum, so I think it's a little bit too soon to disclose into detail how the legal setup was, but basically what we did is we set up an SPV with each pilot partner that purchases the asset and then makes sure that the crypto world or the crypto side of things has a legal claim on that asset, to make sure that both sides are satisfied.
Got it. And from a sort of competitive rates perspective, what sort of rates do those mortgages get?
I mean, competitive or like in comparison to the traditional world, sort of, the rates were, I mean, they're also on a pilot on an MVP level, so they are quite competitive. I mean, like the different rates, I mean, I think we disclosed them on one of our blog posts. So there we, yeah, I mean, what I think the basic or like the most important thing here, or the most interesting thing is here that we made it really financially viable, or like really easy for the companies to enable them, for example, in the real estate example, for in the traditional world, it's just not like financially viable to securitize one mortgage loan. You usually have to go to Goldman Sachs and then have to get lawyers involved, consultants involved. So we reduced that cost substantially, and also time-wise.
Yeah, I mean, it's also like you can go in, like the rates are flexible, right, according to the risk evaluation of the underlying asset. But for example, if you want to compete with like the 20-year mortgage rate in the US, you can make the system do that, right? Because I mean, everything is flexible, everything is programmable. We don't need to follow the central bank's rates. We don't need to follow the official rates. So even if you want to go down, like even further, you can like subsidize the rates, so you can actually go down and be competitive on that level. And then another thing is that it's very like flexible, right? So like traditionally, if you go to the bank and you look for financing, you would get like all the money up front, like day one, and you pay interest rate from it from day one. But as a startup, let's say that you're financing like a real estate project, like with the MakerDAO CDPs, you can just draw out liquidity as needed, right? So like as soon as you have all the assets in there, you can take out like $5,000 a day for the next year if that's the financing you need, and thereby you actually also reduce like a lot of the money you would take out front. So it's in that way it's very flexible, right?
That really quickly, because you were mentioning it earlier with the liquidity pools that you just run, or that you're about to go live with, is that you can adjust, or you can react a lot more flexible than in the traditional world, where the setup is just very restrictive. I mean, you have been mentioning that your users will be able to switch like at any given point in time between flexible
basically variable to fixed rates,
I mean,
and back and forth.
Yeah, we're not supporting this right now, but I mean, if you think long term, this would also be a possibility to just be more flexible.
And for me, like what Gustav has a good point, kind of like you don't need to follow these rates that are in traditional finance, and also kind of if you look at the rates that are in DeFi now, they're actually pretty good. I mean, look at your bank accounts. Like it's not that much that you're getting in traditional finance as yields compared to DeFi. And in one way, you don't even probably need to subsidize in DeFi, because like it creates opportunities to create this kind of gateways to get from basically give fiat, and that was converted to DAI, and that's staked to whether it's lending pools, compound, or for example any yielding protocol. And I think that kind of yields great opportunities as well.
And also to actually instantly access the funding. So it was actually really cool to see on MetaMask, like once you committed, or once you submitted your loan to TinLake, that you can actually see it right away in your MetaMask account to receive the DAI and exchange them. That was pretty good.
It's pretty exciting. I'm probably young enough to end up having my very first loan ever being issued on chain. So I'm excited to try it out. So switching back to Gustav, I mean, you mentioned sort of MCD coming up, multi-collateral DAI. You also announced that sort of first 10 assets that are going to be considered as potential collateral. How do you come up with those assets? Who makes that decision? And how do you then, as a community or as a DAO, elect them?
Yeah.
And who do you count on to actually evaluate the risk with each of those assets to then calculate the over-collateralization ratio requirements?
Yeah, so the first thing, like the current assets that got like chosen, that was more just from like a technical perspective, because of course we've been building the system and testing it for quite a long time now, and that meant that I think they started at it like it was over a year ago. But when they basically were starting to test the system, they needed some tokens they could use as like tests. So back then they just took like 10 of the top ERC20 tokens and created the technical adapters. Because to enter the MCD, you need to have like an adapter that like takes the token and like wraps it so it can actually go into the CDP, so they're compatible. So this is just because these are the tokens where we already built the adapters for them. So there wasn't like a specific like meaning or anything. It was just, you know, a day our developers, they were building and they just took these tokens. In the future, it will be possible to create these. We have two different types of like votes in the maker system. We have what's called like polling, which is like the initial step where you can see if there's interest and support to back like a proposal, and then it's like the executive vote. So in polling, like you can just, you know, come with suggestions to something that should get polled, and this is something that, you know, anyone can do in the community. And I mean, of course, some proposals will come from the maker team as well, but you know, a lot of them will also come from community members and other maker token holders. And then if it passes polling, so that means that enough people shows their support, that they like that specific poll, they like that, you know, asset or collateral type, then it will then go into the executive vote. And if it gets voted through the executive vote, we will build the adapter. And then at that point, when it comes to like the risk assessment and like evaluation of it, we are again having like a decentralized structure around that. So we will basically allow like external risk teams to come in with like making like a bit of creating a risk framework for that asset. So we're tapping into like the global, you know, risk expert community. We have very, very few advisors on the Maker project, but one of them, he's called Alex Laupsch, and he's one of the founders of Risk Metrics. It was a spin-off of JP Morgan in the late 90s, and they have basically created a lot of the risk models that we know from traditional finance today. So their risk models was the reason why JP Morgan didn't get hit by the mortgage bond crisis back in 2008. Fortunately now, he took a lot of distance to that, and now he works only on, you know, like open source frameworks, and he has like a very, very strong community behind him there. So we're gonna tap into that kind of network, and then basically if the risk team gets elected to do the risk assessment, they will receive like a very, very small part of all the profits of that asset. So if they do a very sustainable model that would last for 5-10 years, that will be a pretty good business for them. But if they make a bad model that, you know, gets removed or replaced after 3 months, then they spend a lot of time for nothing. So that's kind of like how we are setting it up. So we, like in the beginning now, we also have an internal risk team. So for the initial tokens, you know, like evaluating, you know, an already pretty liquid ERC20 token, for example, like Golem or something, that's like much easier than if you go into like taking real world like debt instruments, for example, and putting them into a smart contract. So initially, like right now, it's our internal risk team who's working on these like relatively simple ERC20 tokens, but later on we will tap into to the bigger community there. And then in regards to like the loan to value parameters, like basically like the over collateralization ratio, again, the system will be pretty flexible in this regard here. So we have also looked into, you know, having, for example, different LTV ratios for a different, like a single asset. So you could imagine, for example, Ethereum having 3 different LTVs. So one that was 125, one that's 150 like now, one that's 175. And then, of course, if you want the 125, that's for, you know, hardcore margin traders who want like 6-7x leverage or something on their positions. I think maybe you can get 5 or 6x with that one. But anyways, they will then pay a higher interest rate because it's by definition it's a riskier contract, like a riskier issuance that they're gonna make. But you know, if you just want to, you know, take a little bit of cash out on the side and you have, you know, your Ethereum, you're pretty okay with having the 175 one, which, you know, by definition is a much less riskier position.
Got it. And so you mentioned with potentially sort of the different rates being pushed onto some of these NFTs. How exactly would the liquidation work at that point? In the traditional mechanism, you have ETH that's obviously liquidated on market.
Yeah, so there's, in regards to like liquidation, there's like 2 different ways to do it. Either you can get like someone who will, you know, guarantee the purchase of the asset in regards to liquidation. That's relatively simple when you talk about debt instruments, because, you know, if we're gonna go to a financial institution, we can tell them, you know, hey, you know, would you be interested in buying debt at a discount? That's something that they often would say yes to. So in some cases, you can set up a system like that. But it's quite important as well that, you know, we will make sure that you know, people will also get the best prices for their collateral if they get liquidated, right? So we are launching like what's called like the auction keepers. So basically, it's like right now the liquidation is like called the arbitrage keeper, and that's basically just people bidding on like a discount. But when the asset starts to become, you know, more diversified, you can't expect that will be the best model at all. So instead, we have like an auction framework where people, they will participate in these decentralized auctions that will then go in and purchase the collateral, and they are set up in a way so hopefully we'll be able to like optimize the pricing that people get, and thereby the discount. But we also know that some very illiquid assets would potentially tank a little bit more on the price if you need to sell it on the spot, rather than having other like more liquid assets that will be very, very easy to sell.
Got it. So Hugh, we talked about this before, but in terms of the systemic risk that exists for now in the Ethereum ecosystem, with all of these assets that are collateralized in certain contracts, does the whole space have a plan B in case there is a hack or a bug in one of these collateralization contracts, or other than Nexus Mutual, of course?
Yeah.
What have you seen as sort of some of the options that people are thinking about if there is indeed an issue, and can this collateral actually outgrow the security model of Ethereum, for example?
I don't see any other real options out there right now. I just think we need to be conscious of it when we're building, and putting all the pieces together to make something new, and really understanding what the risks are and where they are. You can. How many versions of DAI do we have now? And it's just kind of multiplying, which is really cool, and you can do some really fantastic stuff. And I'm not taking away from any of that, but we also, when you do them, actual people understanding what the underlying risks are of what they're getting involved in is interesting. Like the I've forgotten the project's name you were talking about, but they're basically the on-ramp with the bank, and you put your money straight into Compound.
Wire.
Yeah. So I mean, that's really cool, and I think it's fantastic. And I think one of the reasons that we actually have very high interest rates is because the market's inefficient right now, and so this will help bring efficiency to the market and bring the interest rates a bit down. But the thing is that you're taking a few steps of risk there, and the end consumer may view it like a bank account. So we just have to be careful that we're not making sure the customer understands what risk they're actually taking on. If we just keep that in mind, I think, when we're doing this stuff.
Yeah, I would also say, actually, like, whenever we talk with these guys, like, we always recommend that they look into services like yours. And another thing you can also do, I mean, if you just, like, kind of like the similar, like, if you don't integrate with you guys, but you can also just, like, remove, like, a little bit of the premium, right? And then, make sure that you actually, like, keep some like, deposit yourself, and you have, actually possibility to go and, like, repay people if something goes wrong. But of course, like, people need to be, like, aware of what they use, right? But I totally agree. Like, I would always recommend someone to put on insurance if you make a product that faces a lot of consumers, right?
Yep.
Cool. So, Stani, just sort of coming back to ETHLend days, you rebranded now. That was a really sort of early project at the time, but it was on a sort of OTC style basis. So it was really on a peer-to-peer basis. From my understanding, you've moved on to something closer to a peer-to-contract basis. Can you explain sort of the thinking behind actually probably the scalability of that, how you can actually have a much smoother experience for the users, but what the thinking was behind that?
Yeah, I think like when we started with ETHLend, basically one of the things that kind of like we wanted to do, because it was pretty much the time that people were doing like protocols, so kind of like horizontal approaches, and basically let other people build the products. And kind of like what we wanted to achieve is a vertical approach, that we actually have a kind of like a lending product that other users can actually use directly. I mean, basically, Ethereum users, people who are like aware how smart contracts work, and they basically want the value added that's there. And that was like the kind of like a key thing that we did there, and we really were super ambitious on this, because like we really wanted to showcase that, hey, we have something here that is usable. Basically, I mean, you can basically get yield, and also you can borrow against your collateral that's your long, and get basic cash flow. And those were the basic days before actually DAI, so there wasn't any stable coins. The lending space was very small. So what people were actually doing is they were taking loans to basically just to trade. Now today, like, it's kind of different, because now you can actually take a loan as a stable currency and as a stable coin, basically convert it to your national currency and just pay salaries and so forth. But in crypto, most of the salaries are in basically in crypto as well. And the thing is kind of like it was a radical change back in the days, because I mean, especially for example when Compound came with the pooled liquidity model, they also kind of had an interesting like vertical approach, because as a depositor, you just put assets there and they're yielding. So instead of, for example, in our OTC model, basically what we wanted to do is to connect the borrowers and lenders and basically do their transactions safely on smart contracts. So kind of like what we learned from there is that like what you need to do is just simplify everything, and like your whole product, smart contracts, and everything, and just make it as simple as possible to people to use it, because like there is enough complexity already in the smart contract based transactions that you just can't add anymore. I mean, you just are creating like if you have 100 steps to use a DeFi product, you don't need to create like 100 more steps. And that was a kind of like a very good lesson for us. Like I really believe that the ETHLend model, it will stay. It will be something like Aave OTC for people who actually want order matching, you know. And that model will be basically scalable to a certain extent, where you want to do basically these OTC trades. But what the pool models are allowing you to do for the depository side, of course, is that you will get yield when you deposit the funds. But the more important is the borrower, the actual consumer. And you can get instantly the liquidity there. So what we are trying to just do is kind of like create a model where anyone can create these pools, choose what kind of assets. They can basically have a pool of real assets, like what Centrifuge is doing, and putting those as a collateral, for example. And by the way, in LTV-wise, it's pretty interesting stuff, because the reason we're using high LTVs now in these assets, for example, whether it's Compound, CDPs, or ETHLend, is basically because there's so much volatility involved. Now, if you're collateralizing, tokenizing basically debt, and you have the metrics right, basically you have calculated what's the default risk, operational cost, yada, yada, yada. What basically happens in this stage is kind of like you don't need to over-collateralize, for example, by 200%, you can basically over-collateralize 120% or so. So kind of like you get like a higher cash flow from your holdings, for example. And that's kind of like an interesting change. But in overall, like from the borrower's perspective, we just want to think like what is important for that particular consumer, and that's why we added the kind of like block per block interest rate swaps, and also we added ability to borrow completely uncollateralized, but just for one block. So basically, you can borrow under collateralized liquidity 100% in one block. So this allows arbitrageurs, for example, open with the same block a trade in Kyber, close a trade in IDEX, or just liquidate a CDP or liquidate in Compound. That's pretty awesome.
Really cool. And I think so from the perspective of moving towards pools, of bringing on off-chain assets towards the on-chain world, being able to insure yourself against smart contract failure, it's a pretty exciting time for DeFi right now. One final question is for you, Gustav, and I only dare ask because we know we all love DeFi, we all love MakerDAO so much that we won't hold it against you. But I'd consider that what Centrifuge is building is DeFi, that what Nexus Mutual is building is DeFi, what Aave is building is also DeFi. I can't claim to be building DeFi, but I like to back projects in DeFi. But it's come out that MakerDAO has decided to, or has gone on and registered a trademark for DeFi. Is there thinking around that for sort of defensively to avoid anyone misusing the term, or what's the reasoning behind that?
Yeah, so first of all, like I wasn't part of the decision-making process of this. I found out today when Twitter went a little bit crazy, I guess. But yeah, so I talked with the team, and basically we have seen, some of the bigger centralized organizations trying to coin terms such as stablecoin, for example. So this is like purely like a move towards making sure that like no like company or like someone from outside the space would like go in and like Binance or something would like go in and like trademark DeFi. We also see now that like Tron is doing a lot with what they call DeFi as well. So this was like purely the intention behind the move. I think we got like a lot of like negative backlash from it. I would also say it's only an application. We haven't gotten it approved yet. And like if we get it, it's not something that would change anything at all. We just we would just allow it to be exactly as it is now, and it is not like something that's been done because we want to actually trademark it and say other people can't use it. It's more just so we make sure that one of the bigger contributors in the DeFi space actually make sure that all of us can use it.
Awesome. So maybe we actually are able to put it into a trust that then belongs to some DAO and is collectively owned.
I mean, I don't know how much energy and resources we actually want to spend on it. It was just supposed to be something that we just made sure that no malicious attempt could happen at it. But yeah, I mean, if someone wanted to spend their day job doing that, I mean, I think they would be free to do it.
Yeah, I think for me it was also kind of similar surprise, but I think in one way somehow I deep inside I've been seeing the space for a while, and I still think that it's not kind of okay to take kind of trademark it and kind of be the DeFi, because the DeFi thing is what makes DeFi is basically the community. There is the DeFi space is very small, right? I mean there's a few thousand people building and actually participating in this DeFi space, and basically what makes it DeFi is that everything is as much as decentralized as possible. No one tries to claim basically rights, and I think the kind of even though I understand the kind of the story behind it, and I think it sounds rational, but what I think is also kind of messages a bit in it can be a message that can be taken a bit of wrong, because I would say even though if a big player takes it, pretty much DeFi is recognized as a kind of a community movement. So I don't think that will be a big challenge, but it's still I feel as a person in DeFi that basically it's kind of somehow wrong, because I truly believe that the community, all the builders out there, because Maker is very it's the most interesting DeFi project, and it's basically the backbone of the whole DeFi and the future projects. But basically, we should not forget that the DeFi is actually all those small projects that are building on top of different protocols and gathering this whole ecosystem. Yeah.
And I think Gustav would probably tend to agree.
Again, we didn't do it to coin it as Maker is the godfather of DeFi or the owner of DeFi. That was not the intention behind it at all. So I get that you said it. You can perceive it that way, but I think if you perceive it that way, that's because you choose to do so, right? And of course, we can't do anything against that. There was no malicious move behind it. So that's the only thing from our side. We didn't intend to make people upset or make people feel that we're trying to own it or make people scared about us, coming after them, telling them that they can't use it anymore, because that's not going to happen and really not the intention.
Awesome. So in case Maker does go rogue, I think we can always just return to DopeFi anyways. But with that,
you can just fork it, right?
That's what DopeFi would be. I think we've run out of time. So a great round of applause for the panelists, and thank you very much. Actually, I spoke too quickly. Maybe we do have time for another question from the audience, if anyone wants to launch into it.
It's a bit self-interest question, but I was wondering if this is in reference to the insuring the decentralized insurer contract using old fiat style thing. So I was wondering if these insurers are able to determine in the calculation of the premium the risk that is involved, and in particular the risk that should go down if you have a fully formally verified contract. Because I think there's a nice use case there, because in principle you should be able to have a much lower premium on a fully verified smart contract than an actual bank.
Yeah, I agree. Basically, we have a staking process within the system. It kind of acts a bit like a prediction market, but basically the members of a mutual can stake our native token against specific smart contracts that they think are secure. And so we follow the money, basically.
Sorry, I meant in reference that should that smart contract itself break down, or the blockchain going on it? So a traditional insurer insuring the decentralized insurer. Do you know what I mean?
So you're saying formally verify
Like-
our smart contracts?
Yeah, so like if your smart contract that insures decentralized finance, if that thing would be formally verified, then your insurance premium should be lower than if it weren't.
Yep.
And I was wondering if you have any
When we get to-
experience with an old
I
school
mean, it's
insurer being
definitely-
able to recognize
It's
it.
definitely something that we can look into. We haven't had formally varying stuff right now is very costly and expensive, and
Well,
we're a small
you can
startup.
talk to me
and,
about
you
that.
know, we obviously need to do stuff like that in the future. But yeah.
Okay.
I guess
One-
one last question.
I just have a quick follow-up question. How do you exercise these smart contracts? Is it like the smart contract is connected to, I don't know, to a weather station, and if there is like 500 kilometers of wind power, then it says, okay, there's a lot of probably the houses get destroyed, or, I mean, someone needs to exercise. I mean, there must be an occurrence that exercises the smart contract, right? So how does it work in an insurance case?
So are you asking how the claim's determined?
Yeah, someone has to do it. Otherwise, it's going to be centralized. If I can say, okay, I mean, if someone working there and say, okay, this is now,
Yep.
you know what I mean?
Yeah. We have a voting process. The members vote on the claims, and there's a staking process involved there as well.
Okay.
Awesome. Well, thank you very much to the four of you again, and looking forward to the next panel as well.
So we'll just take a 30-minute break. There's food in the back and cold drinks, and then we'll have the second panel in 30 minutes. Let's take a seat, everyone. The next panel is going to begin shortly. If everyone could slowly take a seat, that would be amazing. Thank you. Guys, can you take a seat? All right, I think we're just about ready for to start the next panel. If everyone could just find their spot wherever they're comfortable. And then I'm just gonna hand over the mic, if we're ready, to Eden Daliwal, partner at Outlier Ventures, who's gonna be moderating the next panel.
There we go. Well, thanks for joining, everybody. I just want to frame today's panel with just a few comments. I think when most people think about decentralized finance, they tend to think of two areas in particular. And so one of them is how can we solve crypto finance problems through crypto-based financial engineering? And the second is, how do we build new financial infrastructure through blockchains and smart contracts? And so neither of these are particularly, human-centered, not directly anyways. And we live in a world today where cannabis businesses and sex workers have trouble opening bank accounts and getting credit. We live in a world where a country like Venezuela is experiencing hyperinflation, and most of the world is still unbanked. And so there's this, the third area, the third challenge that decentralized finance can address is how can we use decentralized finance to increase financial inclusivity, to provide more financial alternatives to marginalized industries, and people living in societies that are suffering from severe and complex economic instability. And so, fortunately, I'm joined tonight with 4 people with great insights in how decentralized finance can elevate marginalized groups. And so I'd like to start off with maybe having everybody just quick introduction of themselves, and then also just a sentence or two on your project. You want to start?
Yeah, sure. Does this work? Yeah. Hi, everyone. My name is Alejandro Machado. I run a nonprofit called the Open Money Initiative. We focus on doing human-centered design research in places where there's been economic collapse or closed economies.
Hi, everyone. My name is Paul Koolhaas. I'm the founder of a project called Molecule. At Molecule, we're building an open protocol to decentralize research and development of molecular structures, primarily focused on the biotech and pharma industry. And so what we're doing is we're essentially creating new open market infrastructure to finance drug development in a much more open and transparent way. And what we're really excited about really is bringing new attention and options for financing and curating new cures in areas of treatments that have been marginalized, like rare and neglected diseases. Yeah.
Hi everyone. My name is My name is Catarina. I work at Fractal as a legal counsel, and I work closely with the Fractal's product team in developing an identity solution that aims to be global, inclusive, as being sensitive to the difficulties that some parts of the world have in having access to identity, and allowing for a reusable use of the identity that we verify.
Hello everyone, my name is Mohammad Mali. I am the founder of a company called AgriCap, which is an online crowdfunding for agricultural projects currently in East Africa, mainly in Somalia. And what we do is basically enable anybody from anywhere in the world to become an investor in these local projects in Somalia. And one of the reasons why we're doing this is Somalia is one of those countries, as you said, that have had collapse of economy and war and conflict. And people still need food. So we realized that we need to do these projects, and we can use the internet to connect to the whole world, including using cryptocurrencies and, So yeah, I'll tell you later more.
So you're building a business in a quote-unquote high-risk jurisdiction. So maybe tell us about some of the problems one has running a business in a place like Somalia.
Yeah, I mean, Somalia is the highest risk, as high as you can get. There are Somali pirates, there are terrorists, we have all kinds of problems. So getting funding to Somalia is very difficult from outside, because there is a lot of actors that are worried about money getting in the wrong hands, which is acceptable. So the problems, for me, I have a lot of problems in the business that we do. One of them, because we are also an agriculture company, and those problems include water problems, because Somalia is also one of those dry countries. Security problems, because Somalia is still a dangerous place. And also financial problems of basically moving money from one place to another. Luckily, we have built a really good platform that has so far attracted investors from more than 50 countries to participate in our project. So actually getting funding for our projects has not been difficult at all. What has been difficult is getting that money to Somalia. So for example, we take cryptocurrencies, Bitcoin and all of the others, and sometimes we have to reject taking those payments because these cryptocurrencies are worthless for us in Somalia.
So how are you using cryptocurrency exactly?
So let's say we want to build a greenhouse in Somalia where we want to produce vegetables. So we find the land, we find the partners, and then we decide, okay, we're going to need $50,000 to build this project. Then we put this on our platform, and our users can then participate. They can use a credit card, they can use a bank transfer, but they can also use Bitcoins to invest. So what we need in that case is to use that money to buy the materials, to build that kind of a project, and to pay the workers, the employees. For me, that's where the problem is, because how do I get this money to Somalia is the difficult part. Yeah, and so far we are succeeding in some extent, but it's not perfect, and it's very high risk so far, because banks are asking questions like, where is this coming from? What is the original source? And so on and so on.
Great. Let's shift to you, Alejandro. So you're also, obviously very familiar with economic instability. Tell us, in your experience, you have the Venezuelan experience. How is money being used in closed economies and collapsing monetary systems?
Okay. So I'm originally from Venezuela, and it's one of the main motivations why I wanted to do this project. I believe that cryptocurrency can help, or cryptocurrency products more specifically can be a source of relief for financial instability. And we kind of started with that idea, but we wanted to understand first how people actually used money in these places, because it really depends. You can't just like airdrop a bunch of Bitcoin or a bunch of DAI or whatever and hope that people will get it and will start transacting this. You have to actually take a much more humble approach and understand what it is that people are currently doing. So right now in Venezuela, people are using the Bolivar, which is the local currency, but as soon as you get paid or as soon as you get remittances from your family, let's say in Colombia, you have to spend that money because every day it's worth less and less. And so despite this, the only asset that is actually available to everybody, it is the Bolivar. So people could try to use something else as money, and sometimes we've seen surges in the use of the US dollar in cash, but most people don't have really access to anything else, right? So the few people that do have other access, let's say to a US bank account, they can have maybe potentially access to other range of products and services. So if you have an account in the US and you can use Zelle, or you can use like digital money transfer systems that are based in the US, but you being in Venezuela, you have an advantage over other people. And so with today's technologies, we have open money systems, we have cryptocurrencies, and in particular, we have stablecoins. And if what people really want is to access a dollar, there's nothing technically impossible in providing that access. But I think it's important to understand that people do need to see that this money is real, right? And how do you do that? The response in the cryptocurrency community is often design systems that are completely trustless and so on. And I think we want to challenge that a little bit and say, leverage the trust that people have in each other and institutions, or in the case of Venezuela, no one trusts the institutions, but they do trust in their local networks of people. And they are somewhat, in many cases, they're good at knowing who to trust and who they shouldn't trust. And when they misplace their trust, they're punished and there's no recourse. So people are kind of have to quickly learn what they can do and what they can't do. And so having, let's say, for example, a service that allows people to convert their money easily into a cryptocurrency, and in particular a dollar stable cryptocurrency, which would be very, very appealing to people, that has a kind of a backing, kind of like there's a brand behind it, and people can actually rely on it, I think would help tremendously.
Interesting. So, Katrina, you are obviously familiar with legal frameworks. Give us some insight, some background on the relationship between the law and marginalization.
Okay, actually the Venezuelan example is a very good example of how law and marginalization can interact. So if you start by looking at the triggers of the crisis, you would flag the political corruption. Please correct me if I say something wrong. Sure. But I took a lot of insights from your publications, and what was interesting to me was to see that you can identify correlations from different perspectives only in this crisis. So you can flag the corruption of the political system as a trigger of the crisis, and then you have the US and international sanctions, but in particular the US sanctions on several industries as a intensifier of the crisis. And that shows the duality of, on the one hand, you had the non-compliance with the prohibition to be corrupted, triggering marginalization, basically, because it was a trigger of a crisis that resulted in severe marginalization of the people. And on the other hand, you have the enforcement of the law. So you have non-compliance, and then you have enforcement of a law that probably, arguably, didn't balance out in the best way possible the goals it is trying to achieve with the consequences it entails. The goals being combating corruption and drug trafficking. And the sanctions are used as a policy instrument to combat these conducts, but they also have severe consequences on an economy. So I think from this you can extract that both the disregard for the law and the enforcement of laws that are not sensitive to the balance of interest that they entail can result in marginalization. And then at some point in your reports you say that in order to leave, people had to break the law. Because, for instance, people couldn't find food staples in the traditional supermarket that they go to, so they need to resort to the black market to find food staples. They don't have any other option to survive, and that's a clear example of how the law marginalizes people once again, because if people are forced to operate outside the margin of the law to survive, they are exposed to further marginalization, because in those cases they are not protected by the rule of law. If there's a scam, there's a scam. There's nothing you can do. And this is a case of the law not acknowledging or not properly recognizing the reality it is meant to address. This is a special circumstance, so you need to afford legal protection in these cases. The traditional world is not working. People need to survive. You cannot make people further marginalized by not being protected by the rule of law. And if we talk about more traditional or old examples of this kind of marginalization, we can talk about sex workers. So that's a reality that when the law doesn't acknowledge or criminalize, it only works to further marginalize these people, because then it restricts access to the social security, to bank accounts, and exposes sex workers to exploitative security methods. And so that's another example of how when the law fails to recognize the reality it addresses, it might result in marginalization.
Alejandro, I saw you nodding a little bit. Did you want to add anything?
Yeah, well, the situation in Venezuela is so complex. It's very difficult to just fly over and have like a summary. But I do think it's important to note that institutions are actually very important, and that having the rule of law is a prerequisite for many things. And not having the state is and like the road towards anarchy, which Venezuela is traversing right now, is something that I don't wish upon anybody, and that it's I don't know, it just like, it's very easy to forget that the law needs to work for the people that it is intended to work. And I would add, for example, that one of the things that led us here were capital controls. And because besides corruption and besides the problems that we cared over even before the current political regime had power, we have always had problems with inflation. So and high inflation produces less confidence in the currency and less confidence in governance. And so it is like kind of a vicious circle that we've been reproducing. But for example, with a specific example of capital controls, people feel the need to break the law to preserve their wealth. And this is something that you can't take away that desire from people. If people feel that they're getting cheated on because they can't just simply save because they're going to lose 30%, 40% of their income annually by just the sheer inflation that's very noticeable. If you live in the West and like inflation is 2-3%, people don't even notice. People don't even talk about inflation. But if you have 40-50%, and in Argentina we are seeing those levels now, it's very clear that you can't trust the state with monetary policy perhaps, and that you need a way out. And so having that closed off is kind of a slippery slope of breaking laws and then breaking trust. And so you don't know, like people often don't know where to stop, like, and what is morally permissible and what is not, because if morality and legality, there's a big gap between them, then we are very much in trouble.
Well, that's a good question. That's a great point. So Katrina, on that same note, what would be some of the conflicts between an open financial system and some of the goals that regulators are pursuing?
Okay, so the open financial system basically stands for extending access to the financial system to the people that are traditionally marginalized. And so granting the right to exchange and to financial inclusion, regardless of any domain of a person's identity, regardless of whether you come from Somalia, where it's very difficult to get an ID card. And that has a lot of merit. But then anti-money laundering regulations in particular that apply to the financial system challenge the unlimited right to financial inclusion and privacy to pursue other legitimate interests. In this case, it's to fight illicit behavior, because money laundering is a key enabler of illicit behavior. Basically, if you couldn't use the money you get from illicit activities, you wouldn't be incentivized to engage in illicit activities. So one of the major routes to fight illicit behavior is anti-money laundering control. And that has a lot of merit too, because some of these illicit behaviors in itself promote marginalization. So corruption is one example that we talked about already. So if you think about the illicit behavior of corrupted governments that favor the enrichment of elites to the prejudice of the development of the country, you can easily understand how there's a merit in fighting these illicit behaviors, because it's in itself they lead to marginalization. And so anti-money laundering laws say no, some realms of your identity are actually important to whether and how you have access to the financial system. So if you're a politically exposed person, you're the president of Angola, then we want your access to the financial system to be extra controlled, because you are in a position where you're more exposed to corruption, and we want to make sure that the funds that you're getting into the financial system don't come from it. And that's a very easy to empathize example, but there are other examples that trigger the controversy around the topic, which are, for instance, in Germany, you having a German identification card will open you the door to most financial services. And the same is not true even for a Portuguese identification card. For if you are from Portugal, you need to have a passport. And the Portuguese identification card is issued under EU regulations, so imagine that applied to other parts of the world. And this is where people have trouble relating, or have trouble empathizing with the goals of the regulators. What is important, I think, in this conflict is that both sides of the spectrum empathize with the goals the other side prioritizes,
right?
Because there's merit in both. Yeah, there's ways to illustrate that. For instance, the recently approved travel rule on virtual asset service providers by the FATF. It's considered a very, of course, it's there to fight money laundering in some way, but it's considered such a heavy burden that many think that it will actually provide the wrong incentives, and people will start turning into decentralized exchanges and privacy coins, and which the government cannot control at all. So it backfired, and the reverse is also true when crypto wants to stay completely outside the margins of the law, and then it backfires because it's banned by a country. Yeah.
Right. Let's shift gears a little bit. Paul, you're working in the biopharmaceutical space. Tell us about how decentralized finance can help scientists and researchers fund their great innovations.
Yeah, absolutely. So we've spoken a lot about marginalization in this panel, and if you think about scientific research and development, it's one of the least financially developed kind of financing areas that we have today. And R&D in the earliest stages of development basically either relies on public funding, there we have the grant funding system via public grant, but at the same time we're talking about like the basis of innovation. And then that science then often ends in intellectual property, and once we turn that into intellectual property, in the current system at least, it becomes extremely illiquid, hard to price. And there we only have private funding, which is then typically in the form of venture capital in the early stages, and later on private equity, and then it turns into like these big pharma companies. And that entire process is either it's completely public and philanthropic, or it's capitalist to an extreme degree. And I say extreme degree because we have a huge problem with drug pricing today. So drugs are increasingly becoming less and less affordable. At the same time, there's many diseases that we still haven't cured that would be absolutely curable, but where we haven't created any of those intense capitalist incentives that are found, for example, for diseases in the developed world. So at the same time, there was a gene therapy for an early pediatric illness that was launched last year, and it's a 6-month treatment that costs $2.3 million for a treatment for a child in the ages of 1 to 3. Now that prices about 98% of people on Earth that have that are struck by that illness out of the market, leaves 2% that can afford it at an extremely elevated price. That's an extreme form of marginalization if you think of it. And it's really, so that ultimate pricing is really a tail end effect of a broken financing system. On the other side, cures for treatments like malaria or tuberculosis, for example, are often developed in the countries that are actually affected by that disease. And those countries also have the most issue in raising funding for those diseases. Even if there would actually be a big global market for a drug, if it was priced correctly, there's no incentive today for like a large pharma company to go in and finance that development. So one of the companies that we're working with is a leading drug development institute in South Africa. And they're developing novel anti-malarial treatments that have been shown to be extremely promising. They're currently in phase 2 of clinical trials. And they were previously funded by the Gates Foundation, which did a lot of work in malaria. And so that's again the example. This is public funding in essence.
Right.
And now they're stuck in Clin 2 with this really promising drug. And one, because they're in South Africa, there's the topic of marginalization, they can't access finance. And two, because it's not really something, like it's not a hot commercial drug to develop. So where does DeFi come in, and like where do we come into this? We think really blockchain holds this potential to re-democratize financing solutions for promising IP on a global scale. So in the same way that on the previous panel we had someone from Centrifuge where they were talking, cool, we're taking real world assets and moving them into these new systems. In the same way, we could now take an IP asset that is, quote unquote, stuck in South Africa and stuck with the regulation of the financing there and move it into a global network where it can become commercially viable again to bring that treatment to market.
That's fantastic. So, you just talked about one stakeholder, which is the scientists and researchers and how they could benefit. And you touched upon, on the other end, there's patients. Let's take an American patient that's now suffering from an illness and now actually facing some significant financial burden. How would a DeFi solution benefit that type of patient?
I think something that we'll see, so I mean, the US healthcare system specifically has a huge problem in terms of that. It's essentially, if you fall ill in the US and you don't have health insurance, it's almost game over. I think, so this isn't something that we're specifically working on, but I think new lending solutions there could really help alleviate some of the challenges.
Right.
I think the other thing is that increasingly in the healthcare system,
could we decrease the cost, the upfront cost of the research? Is there some work or some ideas, some DeFi ideas that you have around that would trickle down to patients?
Yeah, absolutely. So I think the healthcare system, but therapeutics development specifically, can become much more distributed and decentralized. So one of the big issues that we have today is that with the way that IP works, it's really one company that takes a drug and that then has to take it all the way to market. They carry all of the risk and all of the costs. And increasingly, so drug development in some ways is like, for example, let's take IBM as a company, trying to develop the next big social media app. It's probably going to be very clunky. It's going to take them a really long time to develop. Nothing against IBM, but it's like this. We've moved away increasingly from this big conglomerate-driven software development, and drug development still works exactly like that. So drug development is kind of where software development was 30, 40 years ago. So our notion to this as well is like, pharmaceuticals could be much cheaper if they were developed in a more open, collaborative way, but there's no incentives to do that today. So what we're building specifically with Molecule is ways to fractionalize ownership in pharmaceutical IP, creating new market structures that can democratize some of the financing and really drive, so we're using principles called curation markets, using curation markets to drive attention towards the most promising treatments and really accelerate the development of those treatments. So to come back to your question, I think we used that example today, a drug that was developed that is now priced at $2.3 million for a treatment. That's completely extreme. And so we could have treatments that are much more affordable if they were developed in a collective of scientists, of companies working together to bring something to market.
That's super exciting. I think we're going to open it up for questions from the crowd.
One second, just for the recording.
So, can you hear me? Okay. So we spoke a lot about marginalization. Is there a way that you can see that decentralized finance can work together with regulators? Of course, in some places that are more progressive, to just move faster instead of fighting each other.
Yes, that's a topic that is very dear to everyone's hearts at Fractal. And basically, we think the answer involves pushing this trend of open science that started with the open software to the open law. And how that helps. First, there's a lot of marginalization coming from the fact that the access to the law itself is not open. So for you to know the obligations that you need to comply with and what the content of these obligations are, you find yourself paying a lot of money to a decoder of the legal system and the legal jargon, aka a lawyer, to do that work for you. And if you don't have resources to do that, you're out, you're at the margin. So that's one way that needs improvement. We need to open access to the law. And then more to the collaboration that you were talking about between stakeholders. I think the lawmaking process should also be more collaborative and open in that sense. Because, first, because the addressees of the law will tend to be better at identifying the problems that need to be tackled and what works in one approach and what works in what doesn't work in another approach. And also because stakeholders and people that are working on decentralized finance and that are working with technology have a better handle at understanding how the capabilities of a technology can help the regulators achieve the same goal, but in a less harmful way, because it's always about conflicting interests and finding a solution that strikes the right balance between these conflicting interests. This is very difficult, and there are some technological capabilities that the regulator is not aware of or doesn't have a good handle on that could help the regulator get there without harming the conflicting interests in such an intrusive way. So I think that's where I see the potential for collaboration.
Can I add something just very quickly? From a regulatory perspective, I think DeFi actually has huge potential for regulators, because I think the biggest headaches for regulators were caused by centralized finance, like CeFi, which over the past, if we look at past financial crises, like centralized financial institutions again and again overstepped the rules, And what we can essentially build with DeFi is just programmatic rules that you can't overstep. So the whole, the issues that the bank faced with under-collateralization of their assets, like really not having enough liquidity in their reserves, then forcing bailout by the public. With DeFi, we can program regulations into new products and potentially provide a much better solution than we had before.
I think I can provide an example of this, if I can add up another question.
Hello. No, just kidding. Hey, I'm here. Remark for Molecule. Are you aware of the Open Insulin project? Have you heard of this? Open Insulin?
Yeah.
Yeah, so Anthony DiFranco worked for us for a while, and they've also moved from literally like a gene therapy where you can, they're pretty close to, I mean, FDA is in the way to really roll this thing out. They do everything to stop it because it's like you're gonna collapse $1 billion industry, but might be really interesting to partner with them because insulin, especially in the United States, is a huge problem. So, and I mean, maybe you can remark about the FDA because that's like the real thing that makes it impossible. That's just prevents this from. Anthony is a diabetes patient himself, and he's like, I'm not going to inject insulin. They synthesize their own insulin, but he's even like, I'll try the gene therapy on me. Like, I don't need FDA approval, but so you get like counterfeit, open, free. Yeah, I don't know. Maybe you can remark a comment on it.
I mean, there's a big trend in terms of experimentation I think in the pharmaceutical space that is moving outside of the regulatory space. I think it's a larger trend in the same way that we have like essentially like the darknet first made cryptocurrency famous. On the darknet, you have a lot of activity with like alternative substances. There's a lot of people that are experimenting with biohacking, for example, like injecting their own therapies because they're fed up with the speed that regulation is moving forward. There's people reading through forums that are, if you're affected by a disease, you'll kind of do everything to help yourself, which means going onto forums and reading online and you hear about some substance that has never been tested and you find some company in China that will ship it to you, and so people start self-testing and they start like writing about the results. I think all of this sounds kind of crazy, but then like people have always been about self-help, and I think pharma or like healthcare specifically is an area where people have been let down by the government to some extent and by regulators. So yeah, there is a larger trend in play there, and I think DeFi has an important role to play there over the coming years. For example, if we created decentralized autonomous organizations that essentially like communities around new treatments that are being developed fully open source. So one thing that we're also looking at is like, what would a world without patents or IP look like? And what are the business models that we can build around that? Which is way more interesting, but we're still, I think, a couple of years away from getting there.
Let's take one more question, if we have it. We have a question here.
Hi, so on an abstract level, it may be the same question, but it will be different for you coming from Somalia and from you from Argentina. If we are thinking about DeFi and it's at the end of or in the beginning, it's always like converting your currency into crypto. So what would be the incentive of person or organization to step in and introduce this in organization? Say, okay, I can accept your local currency and convert them to the crypto. If inflation rate is so high, can it happen now? Or it's like, no way it can happen now. It needs to be stabilized. And the same in Somalia, like if someone knows that this guy is running around with few $1,000, the risk may be really enormous. So will it happen now, or we need to wait for something to happen before this DeFi adoption comes at all in the countries? So what do you think?
Yeah, I mean, for Somalia, actually, despite everything I said about the dangers, Somalia is actually #1 in Africa when it comes to mobile money. So Somalia has already reached a level of cashlessness that's not paralleled in Africa. So nobody is carrying cash in Somalia at all anymore. Everybody has their mobile phone, and that's where we keep our money. The only problem is that system, I was talking to other guys before, is controlled by telecom companies in Somalia. So unlike Venezuela, we actually reached anarchy in Somalia. Like we experienced real anarchy. But that actually led to an interesting outcomes because our money became useless, just like the Bolivar. So we got rid of it. Now everybody in Somalia uses the US dollar, but not in cash. It's all digitalized, so you send money by SMS to each other in Somalia, and all transactions happen like that. The link that's missing is the crypto link or the blockchain link. This system is USSD based, so it's all SMS, and it's offline, so it doesn't need internet at all. So you really cannot bring outside money. So for me, this is my complaint. When I'm in Somalia, I am like paradise, when it comes to payments. But getting that money in is difficult. And this is where decentralized finance could be useful to open up the world to basically, and also enable Somali businesses to also participate in the world. So now if I want to buy stuff from China, why can I not do it in cryptocurrency if I have it? Now I can't, because my money is tied out in my mobile phone in Somalia. So it will be very interesting if there were solutions within this space that could open up the world for us and connect our island to the whole world.
Mm-hmm. Yeah, in Venezuela, there's a similar situation that the government's not printing any cash anymore because it's just way cheaper to just copy paste money than to print money. So people are using their bank accounts, and they have to use either a smartphone or a computer to transfer money to each other, or they use debit cards, but they have to use the banking system that is electronic, right? They don't use cash. And that has led to many more people being more savvy with their phones about like how to send money and use these like mobile payment apps, which all are really terrible in terms of user experience, but people have had to adapt. And so in that way, we are also kind of, the situation is such that people would be open to still to use the money on their phones in other ways and potentially in better ways. And so I think more to your question, what I think would be most helpful is if we have an array of companies that have a very specific financial incentive to invest in for example, being an exchange between, like local Bitcoins, for example, is making a killing in Venezuela. They're moving $1.2 million a day, and only in Venezuela, right? And so we need more companies like these to realize that they can actually make money from people in Venezuela and in other places as well. And maybe it's not, you don't make a lot of money from a single user, but if you have a lot of people and you're providing a valuable service, and with the scale of the internet, you can reach potentially all of the population. So even if you're providing if you're providing a useful service and it's a financial service, then there's always money to be made. We just need to get more of the context of the local situations to the mind space that we are like here in the crypto industry or in tech in general, so that we can understand the opportunities and then hopefully incentivize some more people to tackle these problems.
I mean, if I just add, like in Somalia, actually, the government is not involved at all in terms of money. It is actually kind of decentralized in a way, because the Central Bank of Somalia does not function. So what is really interesting is, and actually something that crypto world can learn from the Somali payment platform is, it's very user-friendly. Even the nomadic people in Somalia who cannot write and read use it, because it's just about sending money as an SMS. It's not an app, actually. You don't download anything either. You just send SMS. So I think like when you want to make digital services and payment solutions for this kind of marginalized people, you have to consider where people are. And you can't come up with wallets that are 20 digits, and stuff like that. It has to be very simple. And for Somalia, I will actually recommend Venezuela to learn from Somalia, because what is happening there in terms of payment, local payment, I mean, it's just amazing, in terms of user experience. And it's free, by the way, all of it.
And notice that the system that you're describing is not trustless. You're trusting the telco company with your money. Like the telco company can steal all your money if they want, but they don't because they're making money, and because maybe they have, like, besides financial incentives, they may have other considerations, and they have presence in other countries, and there would be backlash, and they don't do it. But it's a system that doesn't protect your money. Like, it is still being held by the company. You don't own your money, but people don't care because it's useful. Yeah.
Well, great discussion tonight. I want to thank the panelists for sharing your insights, and I want to thank everybody for coming out. And I encourage everybody to stick around and just continue the conversation over some drinks.